Welcome, welcome, welcome. Thanks for joining us today. Andrew LeBaron here with Motel Department Conversions. And you probably received an email or notification yesterday about something exciting that we're going to be launching later on this year. Jacob Richard and I have traveled to several different family office events, spoken to hundreds of sellers, including our acquisition team, including Blaine. And we have really learned the ins and outs of the motel hotel acquisition space. Originally, we convert motels and hotels into apartments, something we still have in our tool chest. But there's a pretty exciting shift going on in our business that allows us to acquire even more assets. If you're here, this will be a treat. I'm really excited for you to learn about what we're doing differently, how it's going to be a much less risky opportunity for ourselves, investors, and everyone involved. And if you haven't been here before, please post your name. I want to know where you're from, what you're doing, what market you're in, and just let us know. If you're tuning in from LinkedIn or Facebook or just right here on the stream through the link sent to you in an email, let us know who you are and where you're tuning in from. As we make preparations for our presentation today, we just want to share that the projects that are currently still underway in South Texas are going very well. We're moving right along. Just a little bit of an update. The McAllen, Texas 29 apartment conversion is totally complete, totally finished, and we're filling up units with long-term and short-term guests. It's bringing in average $925 plus per month. We have individuals staying weekly, nightly, and even long-term. So it's turning out to be a great deal, great investment. And for the Brownsville property, we are still underway working with the city of Brownsville to get approvals to continue work in some areas. A little bit of slowdown because cities do that. But it's still looking really good. Hopefully we'll be buttoning up the property or the project here in the end of Q4. So anyways, without further ado, we got Jacob on board with us. Jacob, how's it going? You're on mute.
I said awful. I'm doing really bad. No, I'm just kidding. Doing great. Always doing great. Yes. Thank you for bearing with us as we get our presentation set up.
Awesome. Well, guys, I just wanted to remind you, we are Motel to Apartment Conversions. It's what we do. It's what we've done. Regardless of the packaging, regardless of how it's portrayed, we do acquire hospitality assets. And we do turn them into longer-term, convenient, flexible stays or flexible living solutions. And that's what we've always been about. We do believe that these existing assets are dotting the US, waiting to be converted, waiting to be branded with our new brand known as ParkRise.
Yep. So ParkRise is our brand, and we're going to go into that here in detail. So just starting out, this is the PowerPoint that we have prepared. It's a hybrid of what we have completed for our projects right now, and then also forward-looking statements for ParkRise and the brand and how that's going to look. And so I just want to give a disclaimer that some of the things in here might shift, including potential advisors, partners, things like that. So our core team is Andrew, myself, and Richard Wilson. And so I'm pretty sure many of you who are on the webinar know who we are, but if not, that's okay. I'm Jacob Amesqua. We had started Motel to Apartment Conversions. It's been about 2 years now, right? Andrew and I initially met on a mission. We served a mission for our church, the Church of Jesus Christ of Latter-day Saints. We went to Chile, and we were there from 2009 to 2011, and we lived there, and we taught the gospel of Jesus Christ, and we did service, and we served the people of Chile, And we love God. We are very religious people. We love serving others, and that's kind of the core of our company is honesty, integrity, being able to be successful so that we could bless the lives of other people. So Andrew has a heavy real estate background. He got back from his mission in 2011. He flipped houses. He built a wholesale business. He has over 100 flips under his belt, residential and commercial. He has a property management company called Buy More Time. They do short-term rental management, and they are actually managing our McAllen property right now, which we'll go into in a little bit. And so, super accomplished real estate entrepreneur. And I myself went down the collegiate route. I got a undergrad at Brigham Young University in communications. I got an MBA at Westminster College in Salt Lake City. I worked for Fortune 100 company 3M as a product marketing manager. Then I worked at Experian, one of the nation's credit bureaus, as a product marketing manager as well. I led a product management, product marketing team of a software portfolio of over 500 million. And then Richard Wilson, he came into the picture after Andrew and I connected. I saw Andrew was converting hotels into apartments. He had done 3 projects previously to us connecting. It sounded exciting and fun, and so we teamed up about 2.5 years ago. And then Richard was interested as well, and so we got Richard Wilson on the team, and he's a 3rd member of the company, and he is our capital raising arm, relationship building arm. And so that's a summary of where we came from and where we're at.
This is what we do. We acquire discounted hotels in growing areas. We transform them into apartment-style flexible housing. And it's working really well, especially in this economy, in this market. We've coined this phrase called FlexPartment. I'll let Jacob kind of explain it, but I just wanted to do a little quick blurb here. We needed more flexibility in apartment living, and that's where this phrase came from. Go ahead, Jacob.
Oh no, yeah, it's just a fun slide. Yeah, so this is not an actual definition out of the dictionary, not yet, at least. So we made this slide, and so FlexPartment, pronounced FlexPartment. It's a blend of flexible and apartment, and really, it's a hybrid living space that combines the best features of hotels and apartments. And so just reading this is the best way to describe it. FlexPartments are designed to offer flexibility and amenities that you would typically associate with a hotel, while also providing the comfort, home-like atmosphere of an apartment. And so really, people's lifestyles are changing. We're going to go through in a few slides what the extended stay market looks like and how that's growing. But these FlexPartments are really, we believe that they're the future of modern living. They're versatile, they're convenient, they're comfortable, they're service rich, and they really cater to the evolving lifestyles that we're seeing.
So our brand Parkrise, it's an innovative brand. It's an upper mid-scale brand that we are launching that provides A-class living at a reasonable price point. That's probably the coolest thing that America has seen, right? A-class living at a reasonable price point is what everybody wants. So our mission is to meet the evolving needs of the modern lifestyles. And right now, as inflation increases, as everything seems to be wildly unaffordable, people still want to live that lifestyle, but they don't want to pay that price tag. And we can be competitive. So we do empower residents with ultimate flexibility, convenience, and premium amenities, where you're getting a home-like atmosphere. It's the comfort of what you would call home. It's furnished. It's flexible. There's nobody rushing you out the door or asking you to pay egregious nightly rates. That's what Parkrise is about. It's setting new standards for flexible short, mid, and long-term accommodations.
Yeah. So the messaging here, the branding: stay a few nights, weeks, or months in a furnished, all-inclusive apartment-style suite, or live long-term in a ready-to-furnish space with all the utilities and amenities included. So Parkrise FlexPartments is A-class living at a reasonable price. So you can go to our website, parkrise.com, to learn a little bit more about that. And so just to update you now on, that's what we do, that's our brand, and we want to talk a little bit about how our projects are going. So studio's on 4th. You can see here it was an old motel. We transformed it into a flex apartment. There's 29 units. That was rezoned to multifamily, and right now it's operating really as a hybrid apartment and hotel. It's operating as a flex apartment. And so if you look at the updates here, like Andrew mentioned before, the OTAs are open, and so we are running this as a flexible stay now. So we have long-term tenants that are under actual lease agreements, and then we also have short-term tenants coming in. And we're finding that doing it this way has really it's really accelerated the occupancy that we're getting. It was a challenge in this market to get a commitment for 12-month lease with the size of unit this was. And we have them. I think we have 4 long-term leases that are 12 months. But now we're supplementing those leases with short-term rentals. And so occupancy for May, almost 25%, 50% long-term, 50% short-term. All in, people are paying $90 after fees and everything a day for short-term, and then long-term leases, it's about an average of $900 a month across everything. And so the big update this month is that we do have a refi planned within the next, we'll do a refi in the next 3 weeks here. And so the terms on that refi, it's 9.25% interest, and it's actually a 6-month bridge from the owner of the hotel that we own in Brownsville. And so we have a great relationship with this owner of this hotel that we bought. We bought the Brownsville hotel from him, and he has agreed to be a personal guarantor, give a personal guarantee for long-term financing from a bank, a local bank in the area. And so before that, he's working on getting us all qualified and getting that loan right now. And he said, in the meantime, I'll do a 6-month bridge for you guys. And so it's going to work out great. We'll have the relatively good terms for a bridge financing, and then he will take out a personal guarantee to get the long-term financing for us on the back end. And so within 6 months, within 3 weeks, we'll have this refi for the bridge loan, and then within 6 months, we'll have our permanent long-term financing. And we do plan to have a distribution to investors in Q2 this quarter.
Thanks, Jacob. Exciting on McAllen. The Brownsville deal is also exciting. Remember, this is an 80 units plus a restaurant. And right now, we are renovating 40 units while the other 40 units are actively being leased. It's not 100% occupancy in the 40 units that are being leased, but we're picking up some steam there. And we're working with the city of Brownsville to release permits. They want to see some adjustments made to plans. We resubmitted plans from our architectural and engineering team. They're being reasonable. They're working with us, which is great, and they're faster than other states and municipalities in the West Coast or the East Coast. So it's looking good there. We're getting it's exciting. There's actually a couple things they wanted, and we were able to negotiate exceptions for the things that they wanted, including a fence in the back. They wanted just a random fence in the back, and we don't want to put our cash in a fence. We want to put our cash in the building. So it's been a kind of a long process, longer than I'm used to, but it's coming around. So it's looking good.
And this is what Brownsville is being renovated into. This is our room design for Brownsville. And so you look at that, and it truly looks like a flex apartment, hybrid hotel and apartment. We are working with getting a pretty accomplished designer to have a standardized template of what all of our flex apartments will look like going forward. But for now, this is what Brownsville will look like. And so a lot of words here. You'll have access to this recording. You can go back and pause and look at this. But the Park Rise Advantage, Corky, real quick. Yes, that's a great question. I just want to
let's highlight.
this.
Sorry about that. Go ahead.
Yes, you actually can. So there's something called a discounted rollover, Corky. I don't know if you've heard of it. A discounted rollover is when you take you take a traditional 401k or traditional IRA and you invest into a project on a hotel that's operating at a certain, yep, operating at a certain percentage. And so you get in with your 401k when the hotel is this valuation. And then the hotel becomes devalued when we shut it down, we do our renovations. And so the value of the hotel is, it goes down once we start our renovation process. And so at that point, you take your traditional 401k and you move it to a Roth 401k or a Roth IRA. And so you have to take the tax hit, when you do that. But at that point, you can purchase, you can buy back into the deal at a lower valuation on the property with your Roth 401k or Roth IRA. And so then you're in at a lower valuation. And so eventually, if this was the original valuation of the hotel, this is it during renovation, you got in on a Roth when it's lower, and it's going to be up here. That's the value add, right? And so that whole gap between when you got in from your Roth and changed it to your traditional is tax-free. So I did a terrible job at explaining it, I'm sure, but it's a legitimate strategy. It's called a discounted rollover. That's one area where you can have tax savings. And then also we distribute K1s every year. And so that'll reflect any type of loss or any type of tax advantages will be distributed through the K1. That's where you'll get that from. And so yes, there are tax advantages during the renovations for sure. So the Parkrise Advantage, where you look at some of these bullet points, you have flexible living, you could stay short or stay long. These are going to be more spacious than normal hotel or normal extended stay. And so, and they'll also be furnished. And so you get to enjoy the privacy and roominess of your own apartment. It could be furnished. Easy approval and move in. So there's no leasing agents. Let's say you're going to be in an area for 6 months to a year, and you need to get in quickly, and you don't want to go through the whole process of negotiating a lease agreement and canceling the lease and changing utilities into your names and everything like that. There's nothing like that. It's there's no hassle with utilities, no lengthy application, no leasing agents. You can truly have flexible living. And then while you're there, you can have premium amenities. Our Brownsville hotel, our flex apartment has a pool. It will have it'll have a laundry room. It's in a great area. And so you have the added amenities as if you were in a hotel, added service. And then anything else you want to add here? Andrew, it's kind of a crowded slide.
No, I think you nailed it. It's just flexible and it's all inclusive. The flex apartment and the Parkrise difference, we believe that it's an underserved market that we're capturing. You're going to notice on some slides in the future where you'll see other brands, other companies building flex apartment style stays. There is a massive need, wildly underserved. And let me just paint a picture. In Arizona, just so you know, even with the rate not really budging much, we're still undersupplied in inventory. People are also being priced out, but they're still buying. And the tenant profile is growing. That pool is growing. We have a lot of people that are looking to be in between homes. We have corporations that post-COVID, they travel, they go to different locations, and they're looking at hotels, Airbnbs. Occupancies have risen, hospitality occupancies have risen, but these hotels are not offering what an extended stay would offer, or they're not offering reasonable rates or even a comfortable stay due to its architecture and the way it's built. So this is where a flex apartment would be perfect for this growing need across the nation.
Yeah, I believe we have some. Okay, so this is kind of our position. So other people are doing similar things to this. You look at Marriott Apartments, and we're going to go through a slide where it's showing the huge shift that these big hotel chains are taking to be flex apartment. So you look at Apartments by Marriott, that is their long-term, longer stay solution. Home 2 Suites by Hilton, fits more into kind of an extended hybrid, an extended stay. There's a company called Stay Apt. I don't know if you call it Stay Apt or Stay APT, Stay Apt Suites. Anyway, I like the name Park Rise better, but Stay Apt, Stay Apartment, but same thing, same deal. And then you see kind of your Holiday Inn Express, your Woodspring Suites, and then you have Waterwalk. Waterwalk is we're pretty much emulating Waterwalk. That's truly a flex apartment. You have the option between furnished and unfurnished, but very expensive. And so we're fitting into this area right here where we have the flexible terms, we have the premium service, full functionality of an apartment, but with the hotel benefits at a reasonable rate. I wouldn't say affordable. We're not going for the affordability factor, but our phrase is A-class living at a reasonable price. And so we feel like we'll be very competitive with what we're building here to fit into this market.
Park Rise offers a lot more than some of the other brands out there in its current offering. I do have a question by Corky, and we'll just get to it real quick. He's asked, "Are you able to quantify through research the demand desire for customers to use this product?" And Jacob did answer yes, and we'll get to that a little bit later in this presentation. There's also another time we can also show or showcase CoStar reports and
there's a slide I think next that shows it.
Awesome. Yeah, Park Rise, what is it? Is it apartments? Is it hotel? What is it? Well, it's that fusion between hospitality and residential living. It really is. We have on-site 24/7 support and service concierge. It's got in-unit done-for-you services and laundry. It's flexible. If you just need a week, if you need a day, if you need a month, if you need a year, Park Rise delivers. And we offer furnished and unfurnished units, which we've talked about before. But what that allows guests to do is, first of all, they're getting a rate that is wildly competitive amongst other opportunities out there. If someone wants to be in for 6 to 8 months and they have their own furnishings, they can bring it. For those who maybe are shorter term, but they still want the furnishings, we have it. And for a lot of people in this post-COVID environment, virtual is number one, especially young people, millennials and Gen Z. They're becoming business nomads, and they're not looking to buy a home. They're not looking to buy an apartment. They can't afford it. Inflation's way too high. Rents are wild. So they need flexibility. They want to move about either traveling or the country or wherever they need to go with flexibility, without lease agreements holding them down. And Park Rise is a viable option.
Yep. And so the brand advantage here, and we've talked about this: online on-site reservation, easy instant payment methods, move in. For the owner, this is all these things are very good. There's a lower management burden because of the extended stay nature of the tenant. Instant reliable payment collection. We have their credit card on file. Fills up faster, relatively speaking, than an apartment complex. And we're going to go into the market here, what the market looks like, just to answer your question, Corky. So for the market analysis, we are in the extended stay niche. If we had to pick a niche that we were in, that's where we would fit ourselves. And extended stay is overperforming. It's outperforming hospitality in every way. There's been the lowest occupancy for extended stay in a decade. There's record high revenues across all the extended stay segments. Room revenues are up 3.3% compared to the previous year. RevPAR, it increased by 1% compared to fourth quarter 2022. Higher occupancy, 12% higher occupancy than hotels. And then this last bullet point is really interesting. The second lowest net gain in new rooms in 10 years. And so you're seeing all this elevated performance, and there's not enough, and there's not an oversaturation of rooms being built like apartments. we're seeing a lot of new build apartments, and we can show data that goes to that. But there's a ton of new builds in demand. But these extended stays, and especially the hybrid extended stay, the extended stay that offers even more flexibility, more room for price reasonability. That's something that there's a big move toward. And hotels, these big hotel brands, they realize that this model is very, very lucrative, and it's a very big opportunity. And so just in the past year, really, past 18 months, we're going to go through acquisitions, but hotel brands want in on this hybrid. So Waterwalk, for example, they were just acquired by Wyndham. And so Wyndham, they acquired the brand Waterwalk. Their 11 hotel portfolio is now being managed, and it's in with Wyndham. So Wyndham acquired them, the flex apartment model. Hilton announced last year their new brand. It's apartment style suites, targeting guests booking at least 20 nights. It's called Project H3. And so that's coming up. It's a lower mid-scale project. And then Hyatt announced last year their extended stay brand. It's called Hyatt Studios. And so again, that's apartment style suites, upper mid-scale extended stay. So that would be a direct competitor to us. And then Marriott, their extended stay, they announced Studio Res. And so that's another mid-scale kind of flexible stay solution. And so you look at these new announcements and the trends that are happening to have these longer stay brands, it's growing rapidly. And so, great question, Corky. So both is the answer to that. And so, and I'll explain here. And so if you look at Wyndham, you look at Hawthorne, you look at Marriott, they have Residence Inn, Town Place Suites, Elements. They're acquiring these. So the answer is that these examples that I showed, 3 of these are new builds that are going to be built and owned by the brand. Waterwalk is an acquisition, and so that is acquiring a brand that's actually already, it wasn't a part of their portfolio, but they're acquiring it, adding it, and adding it to bolster their portfolio completeness. And so instead of converting current properties, what these big brands are doing is they're acquiring companies like us, companies like Parkrise, a brand that has established itself as a unique niche in this growing industry. And so if you look at the M&A, and I'd say the best question to answer that is the big hotel brands they're focused on M&A in a big way. So Waterwalk, it was acquired by Hyatt, April 2024. Graduate Hotels, that's also a niche university town boutique lifestyle hotel brand. That was acquired by Hilton, March 2024. There was only 35 operating hotels, and in the pipeline, $210 million acquisition by Hilton to acquire just the brand Graduate Hotels. Dream Hotel Group, again, it's a they have mid-scale, upscale, and luxury. It's another lifestyle hotel brand that was acquired by Hyatt November 2022. It's a $300 million total acquisition cost. You look at Nomad, no financials disclosed there, but another niche local luxury lifestyle hotel brand that was acquired by Hilton just past couple months, last month, April 2024. Providence, another boutique independent hotel lifestyle operator, acquired by Benchmark Pyramid. City Express, that's a more affordable mid-scale hotel chain acquired by Marriott, October 22, $100 million acquisition. And so the era of these big, huge consolidations, I think, is largely over from the research that we're doing. And what we're seeing now is that there's more smaller deals to strategically acquire innovative lifestyle brands or brands that can add to a big hotel's portfolio. And so if we go back to this slide, that's what Wyndham's doing, that's what Hilton's doing, that's what Marriott's doing, that's what IHG is doing. All these big brands they're basically just tacking on brand after brand after brand into their portfolio, and they are wanting to build out that extended stay, that longer stay portfolio more and more. And so that's the trend that we're seeing, and that's really what we envision with ParkRise. We envision building ParkRise to be a 25 to 50 unit portfolio of franchise ParkRise flex apartments, and then that is the exit strategy would be to sell the ParkRise brand to a major hospitality company in 3 to 5 years. And we can go through that valuation, but this valuation that we're projecting is the same valuation that Graduate Hotels was acquired for by Hilton. But when we're looking at what we're trying to do here, it's build that portfolio of franchise ParkRise flex apartments, sell it to a larger hospitality company.
Our long-term vision, we already covered that. The building style suitable for ParkRise conversion. You're probably wondering, okay, so if you're going to convert these, what is it you're looking for? Who is it you're focusing on? And there's a lot of different variables involved, but basically we're looking for economy of scale. We need 100 doors minimum. It needs to be an upper mid-scale extended stay. I believe, Jacob, if I'm not mistaken, the next slide talks about the brands, and we can cover
Yeah.
that here after this one. But they need to have kitchens or kitchenettes. It needs to be already plumbed. It needs to have the electrical. It needs to be set up with that kitchen and that long-term living solution already there. Doesn't need to be blown out to ParkRise style. That's where we come in and build it out to our ParkRise style, but it needs to have it. Has to be interior corridor, and these need to be light cosmetic. Doesn't need these can't require gargantuan amount of capex to get it to where it needs to be. It needs to be in great locations. We're talking large MSAs, large cities, areas where there's heavy migration, Sunbelt states preferably, places where people are moving to. And again, there's opportunity everywhere in the U.S. and we're open to really any part. And the potential market occupancy has to be hovering above 80%. As mentioned, where migration's headed, you're not going to find a problem with your occupancy being above that 80% mark. And independence preferred, not required. Independence tough to find under the rest of these parameters. Finding something 1990s or newer, that's an extended stay asset with kitchenettes, interior corridor, 100 plus units. It's going to be tough to find those independent, but that would be the cream of the crop where we could show up and bring true value to the owner. And these are the brands. There's a reason why we selected these brands. We think these brands do a great job of building products that look really exactly what ParkRise should become, or I guess I would say the outline of what ParkRise could be, where we come in and we do construction and build it to become something greater. But these brands also allow us to acquire them easily. Obviously, it's a negotiation with these hoteliers because they are franchised to work out an agreement. But in the end, these companies build great products where we can come in and add our ParkRise signature to it.
Yep. And so the growth plan here, and we are realizing that the fastest way to scale and the most responsible way to scale is really through focusing on franchising and not owning the actual real estate all the time. We're still open to owning the real estate. We obviously own a couple of hotel conversions that we will brand as ParkRise now. But really, the way to scale, and in this market right now where debt is difficult, it takes a long time to do the due diligence on a property, to raise the equity, to source the debt, to make sure that all of the T's are crossed and the I's are dotted, and however you want to say it. It's a long, drawn-out, risky process for operators right now to acquire and do value add on hotels and on multifamily. And I'm sure that a lot of you as investors right now, you're seeing that. It's a tricky market. When debt is bad, there's always risk, but especially when the markets are not ideal, it's always a risk. And so we're seeing here that we believe the fastest and safest way to scale Parkrise is to approach existing hotel owners where their hotels meet the criteria of what Andrew just described, and offer a solution to franchise with Parkrise. And we're working out the details right now on why they would want to franchise specifically with Parkrise, but we have a lot of really great things in the works. We have a great board of advisors that we're building. One of the reasons is because of this unique niche of being a flex apartment, and then we're also exploring some options of offering very competitive franchise terms for the owner. And then we are also offering to be the operators of everything. We will manage the project, and we'll manage the property. We will manage the renovations to get it to Parkrise standards. We will do everything. And so this is our franchise timeline. And we're like Andrew said, we're averaging 100 units of property. And so within the next 3 to 5 years, we are looking to scale up to be around 29 stabilized properties by 2029, with 12 that are contracted and 12 kind of being renovated up until it gets stabilized. And then we have a ton of metrics on how we came up with these projections. We can make them public and send them over to you, but the average hotel, we're estimating it's about 2.7 million in gross revenues, and there's a lot of different things. We could send it out, but generally speaking, once we have in 2029 the amount of hotels that we expect to have stabilized, it'll be about $58 million in hotel portfolio revenue, $22 million in hotel portfolio EBITDA, and then our company, Parkrise, or our brand, it'll be bringing in franchise fees and royalties, and the total revenue we anticipate to be $7 million in 2029 with a $2.1 million EBITDA. And so when we go back to the valuation of the exit that we were talking about earlier, it's off of those numbers. And so the $9.8 million exit that's planned in the next 3 to 5 years, that's a 13.1x revenue valuation, which is equal to Hilton's graduate hotel valuation and property, and between 11 to 13 x valuation on the revenue is standard for these types of exits. And so that's kind of a really fast, high-level summary of where we expect the financials to be and what we expect the exit to look like. And so, did you want to go through any more of the franchising details, Andrew?
Yeah. The question, and Corky, you bring up great questions. Corky and I spoke yesterday, Jacob. We actually had an hour-long meeting yesterday where we discussed this business plan. One of the questions, and maybe I'll ask it before anybody else does: why would any hotelier choose our franchise over renewing with their current franchisor or a different franchise? What do we bring to the table that's specifically different? We do bring something that no other franchisor is going to offer. And let me start off by telling you what a franchisor does when they approach a hotelier or they want to renew the franchise. They say, hey, here's a list of all the things you need to fix with your property. It's called a PIP, a property improvement plan. But they say, here's your list. Here's your stack of papers. Get it done. If you don't get the flag. We're not going to plant our flag on your building. And the reason why hoteliers want these flags is they want that notoriety. They want that traffic. They want that brand standard. So what happens typically is you have a hotelier that decides, do I want to put all this cash into it? I got to call a GC. I got to get all this done. Where we come in is we do that for you. We do that for the hotelier. They don't have to worry about that. And then on top of that, we'll manage the property for them. We want them to be successful. The whole goal of Parkrise is to create wildly profitable hoteliers with an apartment-style flexible living hospitality asset. That's what we want to do. Make them wildly successful and really bring up their revenue. We want to improve their revenue. So anyways, I wanted to just blurb on that. And Corky had a great question. I think this is important just to bring up here. Would a business model work with an existing distressed property that's poorly managed multifamily properties? So multifamily, could you do this multifamily? It's a great question. You probably could. The reason why we wouldn't is because our whole exit plan is to sell to a brand. We want to sell the brand to a Marriott, to a Hilton, to a Wyndham, to a Hyatt. That's our whole purpose is to do so. And you know, uh, we do believe that they invest heavily in their architectural design and the hospitality setting. And there are these large 100 plus unit interior corridor properties. You don't see a whole lot of brands in their with their holding inside their holdings with exterior corridor apartment style buildings. You just don't. But it could work. The other issue you might run into is you got to go back to the city and reverse it. You got to talk to the city to give you a conditional use permit for transient living. That's actually harder to do at that point. The reverse is harder than converting hospitality to multifamily. You can convince a city that you need more housing. It's hard to convince a city that you don't need housing. You need more flexible commercial hospitality spaces, and that's a tough sell. It is possible though. The other issue is if you tried to run it that way, you might trigger I mean, lending could be problematic. You might trigger the city. They might, hey, you got transients here at your building. This is zoned R3 multifamily. So great question, Corky.
Yeah, and management is everything. Management will be everything, and it will break, it will kill a brand, it will make a brand succeed. And so management is the most important thing. We're learning that. We've learned that. Everybody, I think, understands that. Andrew, like I said, has built a great short-term rental management brand. It's called Buy More Time. We eventually will own the management company of Parkrise. Right now, we are going to rely heavily on a partner named Island Hospitality. Island Hospitality managed Waterwalk, the brand that was just acquired by Wyndham. They manage Marriott, Hilton, Hyatt, Starwood, IHG, over 160 hotels. And they are a full service hybrid extended stay flex apartment management company. And so in the beginning, what we plan to do is really lean into their expertise and to make the project successful and work with Island Hospitality to manage and customize to how we need it to be. Island Hospitality will manage our Brownsville property, which is great. Great news for all of us, for investors. It's going to be run very well. And the reason why this flex apartment model works so well is because the operating expense ratio is more comparable to multifamily than it is to hospitality. And that's very important for the net operating income of the property. I mean, the lower the expenses, the better, right? For the valuation of the property, for the cash flows coming in, everything. And so the more, and that's kind of the trade-off, right, between multifamily and hospitality is you have this higher possibility of more rents coming in if you have a hotel and hospitality, but at the same time, there's more churn, there's more operational cost. Whereas a multifamily, it's usually a lower monthly income per unit that you're creating, but you have that stability, not as many operating expenses or seasonality changes. And so that's the beauty of the flex apartment. It's kind of right in the middle there. And so has a reasonable operating expense ratio is what Island Hospitality is putting up of 63%. And then average estimated occupancy, it depends on the market. You look at the occupancy stat that we showed for typical extended stay. It's right in that 75% range. We believe we could be much higher, especially with just our past history of how our properties have performed. But Island Hospitality for the management company is going to be what can kickstart us into franchising. Anything you wanted to add there?
No, that was excellent.
Okay.
Construction management. So we have recently built a good relationship with a few individuals over at Waltz Construction. Waltz Construction is a commercial general contractor, and they actually have experience with conversions. They've done this before for large private equity firms. They're in the hospitality, multifamily, industrial, K through 12 schools, sports and recreation. So, I mean, if they're building steel masonry, school structure, charter schools across Texas and Arizona, for sure they can enter a an extended stay hotel and really add cosmetic upgrades and some improvements there. So they're very capable. Some of the recent projects they've done include ground up apartment developments, industrial developments, and as you could tell, the K through 12 in Dallas, actually, no, Austin, in Austin, Texas. I think they have 3 that they've recently completed. Great company, great founders. Really excited about unique niches like ours.
Yep.
Awesome. Thanks for
That's
joining us today. Is that it? Okay, cool. So, yep. Well, here's what I want to leave you with this. And first of all, thanks for I see how many are in this webinar. I want to thank you for coming. I want to thank you for being here. This is probably something you haven't heard from us. If you've been talking to me personally, if you reached out, that's my cell phone, by the way. You guys should text me. If you don't take that phone number down in your phone, um, I mean, you definitely can. You have the opportunity to annoy me if you want. No, I don't get annoyed. You could send me a text at 1 a.m. I'll answer it. But this is a different message that we've had before, slightly different. Before it was we're going to go hunt down these hospitality properties. We're going to go find the motels, the ratty tat motels, or the really struggling product, in even secondary or tertiary markets, and we're going to convert them into apartments, needed housing. The strategy by which we convert the unit hasn't changed at all. In fact, it was a precursor to what we are becoming, what ParkRise is becoming today, this brand. We feel America is in need of this product, as noted by Hilton, or Hyatt, Marriott, as they build their own brands. We are more flexible. We're lighter. We don't need to build from the ground up. We can acquire existing poorly performing assets, provide a better solution for owners, and still become wildly profitable in the franchising. It's even an opportunity for us to take first right of refusal, which we can talk about on another webinar. It's still an acquisition opportunity for us. I want to thank you for joining us today. You probably have a million other questions, which Corky, you did yesterday, which was excellent. Please reach out, send us an email, send us a phone call or text, and let's keep in touch.
Awesome. Thank you, everyone.
Thanks, guys.